Hello, accounting 504 students. I've been recording these videos all day, and thank God this is the last one. But this video is going to be on, we're going to finish the worksheet and that we started, and let me get it up here. That's the worksheet right there, and we're just going to finish it. Now keep in mind that what we've done previously is we have valued Lily, assuming no growth using two different methods. Multiple methods for getting the same result actually give you a better perspective and understanding of the firm and its growth prospects and how the model is working. So, there is a third method too, by the way, which is called the float equity method, which would be very simple. I prefer not to use that method because I believe in what Modigliani and Miller said, that assets count most, and there is some tendency in real life for the degree of financial leverage to throw that price off. That may have been part of the article I sent you. I don't know. For fun reading. Anyway, so let's get right into this, and we will we'll go ahead and do the final part of this, which is part two of this, which is really we're going to look at the value of the firm, and rather than being no growth, we're going to assume our usual two-stage model, and we're going to assume a 20% growth super growth period and an eternal value period. We'll do a short form type of valuation for this. Okay, and let's just put in our assumptions here. We're going to have, move this down a little bit. I'm going to have super growth period, excuse me. So we're going to have a super growth period. Okay, and we'll have the during the super growth period, we're going to assume the growth rate, doing that, growth rate, let's assume the growth rate during the super growth period is 20%, which is probably, for that time frame, not bad. So we'll make that assumption right there. Okay, and let's assume the cost of capital, so the super growth cost of capital. Let's go ahead and we'll use the weighted average cost of capital that was computed above. It'd probably be a little higher than this because might be close. No, actually, it might be pretty close. Okay, so the cost of capital was just over 11%, so I'll use that weighted average cost of capital. So that's for the super growth period. There's other ways to compute that, by the way. You can use a capital asset pricing model and make adjustments, but I don't want to do that. Okay, and then we're going to have a constant growth period. So I'll have a constant growth period. Okay, I got constant growth period. The constant growth period, we're going to have the growth rate. The growth rate here. Have a cost of capital. Okay, let's assume the growth rate, it's constant growth, so we'll assume 0.01, 1%. See if I can get this line out of here. That's a border. That doesn't matter. That's just a border. Border that thing out. Okay. So anyway, so let's assume a cost of capital of 4%. I'll leave 3% between those two things because it gets the price down a little bit. Okay, and now we will do our valuation. So we'll do the valuation here. And we're going to do the super growth valuation first, the usual way. And then we'll do the terminal period later. Okay, so super growth valuation. Let's go ahead and number the years. There's 5 years. 1, 2, 3, 4, 5. And change that formatting. I don't think this had dollars in there. Let's go ahead and change the formatting. Obviously, these are not dollars. This is just time period. Okay, so it's a number with 0 right there. And we'll put the period here. Then we will put the year here. Okay, then we'll have the cash flow in this column here. Once I get over there. Okay, we'll have the cash flow right there. Then we'll have our discount factor here. And then we'll have the discounted cash flow at the end. So we'll have the discounted cash flow at the end. We'll do that. Looks fine. Okay, so the reason I'm putting the year is this was the financial statements were really, I believe, for 2002. So 2002 would be our base year, and then 2003 would be the next year. So we'll just go from there, and I'll just go ahead and get these out of the way. And okay, so the cash flow for 2003, I'm going to cheat a little bit, and you're going to see there's an error here, but I'm just going to go ahead for the hell of it, just to keep it simple. And what I'm going to do is my cash flow, it really is for 2002, but you could take it for 2002 and multiply it times 1.2. I'm just going to go ahead, keep it simple, use the free cash flow to the firm you initially calculated. I'll grow it 20% out. Technically, I should take a 2002 cash flow, which is this 1633, and multiply it by 1.2, but I'm just going to do this the simple way. Okay, and then I'm going to go ahead and for this cell here, for this next cell here, is I'm going to take 1633, and what we're going to take is equal to that times 1 plus the super growth rate, and I'm going to raise it. What am I doing? No, that's it right there, of course. Okay, that's 1861, and of course I'm going to go ahead and put some dollar signs there to freeze the weighted average cost of capital. So right there are my cash flows growing, I believe, at 20%. I'm going to see if this is right. This actually looks a little low. Now, what am I doing? Kind of make sure my formula here. I took C times C230 there, which is the weighted average cost of capital. I'm getting 11% growth. I got to change this number to C229 there. Okay, that's a little better there. So if you look at the formula right there, I'm taking times the 20% growth rate. Okay, now we'll do our discount factors. Okay, now the discount factor is going to be 1 divided by 1 plus the weighted average cost of capital from above, and I'm going to raise it to the first period here. Hopefully it goes through. That looks appropriate, and I will freeze the C and the 230. That is correct, and I'll just go ahead and copy that down. And so that's pretty striking now that shrink this little ellipse. That's pretty striking that how fast the value of a dollar is declining. At first year, it's worth 90% almost, and 5 years later, its discount factor says dollars. 5 years later is only 60%. Okay, then we'll go ahead and calculate the discount, the value of our free cash flows. Okay, so we have this right here, have that. Okay, and so the value, this is typical value of super growth period, value of the super growth period is going to be the sum of these numbers right here, and you get 8 billion more or less. That looks fairly reasonable. Okay, then we'll go down here and we'll do our terminal period growth. And this is all the typical stuff we've already learned, okay, that we've been doing. Okay, but it'll be interesting to see the difference, how much growth is worth, the difference between the no growth price of $11.66 and what we get here. Okay, so terminal period, we know I'm going to have the numerator. Spell numerator correctly. Numerator. So let's do the numerator. And then we're going to have denominator. Denominator. Okay, and you know that the numerator is going to be your, and I'll put it here, your cash flow at t plus 1. This is your cash flow at t plus 1. And you should know pretty much from now how we get that. And I'll just put here, and that's going to be, we're going to grow the final cash flow times 1.01. That's our growth rate. Okay, we'll do the calculator second, and the denominator is the terminal value, the constant growth cost of capital. So it's just the cost of capital minus the growth rate. Okay, so here's where we're going to do this. Our numerator here, I'll put it right here, is equal to the year 5 cash flow times, in parentheses, 1 plus the growth rate for the terminal period. Okay, that looks about right. So that number grew by 1%. That would be our year 6 cash flow. T plus 1. T is equal to 5 in this case. Okay, and our denominator is going to be the cost of capital less the growth rate here. Okay, so our terminal value at year 5 is going to be equal to 3421 divided by 3%. This gives you that number right there. Okay, now we got to multiply that times the discount factor. We've done this so many times at this point. You know what's going on. Discount, I'm going to say 5-year discount factor. So 5-year, the 5th year discount factor. Okay, which is this number right here. Okay, so in order to discount the terminal value at year 5 back through toward 5 years, we've got to multiply times discount factor, and the product is going to give us the present value of terminal cash flows. And we'll just put an underline here. Okay, so it's equal to 114, about 59% of it, so 6746. And I'm just going to go ahead and put it out here too. Okay, so far we've got two values. We've got the value of our super growth period. We've got the value of our terminal value. Okay, and what I'm going to do is just as I usually do, I'm going to add them up. I'm going to say, so this is the value of assets. It really is the value of assets. Okay, I don't know why it came out yellow there. We'll just tolerate it, which is the value, your super growth value, plus the present value of the terminal cash flows, and it gives you a value of 75 billion, more or less. That looks pretty good. But here's the question, and here's why I said value of assets. Okay, and so this is the value of the assets. And the reason I can say this is pretty much the value of the assets is because, and this is important, because I started, this is, I used for my cash flows, I use free cash flow to the firm, which is the value of your assets. You know, free cash flow to the firm is the value of your assets. You haven't taken out the interest expense, so I use free cash flow to the firm there. And then for the discount factor, I use the weighted average cost of capital. So the numerator and denominator match in a sense, or if you're going to use cash flow produced by assets without taking out interest expense, you've got to use free cash flow to the firm. If we take out interest expense, you use free cash flow to equity. Okay, but that's what I'm saying. Free cash flow to the firm correlates with assets. It's what the assets of the firm produce. Kind of going back to this concept here, that assets are what drives firm value. I like to do it this way. I really believe that assets drive firm value. With no offense to my finance colleagues. Okay. So there's your assets. Now let's do a couple things. Since we've got the value of the assets, let's make a couple of adjustments. Now those would really be operating assets because operating assets are what drive growth. I'm just going to go ahead and I'm going to add in, like I've been doing, the value of, and this is going to be a plus, value of non-operating working capital, and we've got that number somewhere on top, minus, and this is the one that you could argue with me on because I'm using book value of debt, minus book value of debt, okay, and then so if we take the assets, the operating assets, and these really are of operating assets, your plant, even your buildings, and your labs probably. That's the value of those assets. We're going to add in the value of stuff like cash and marketable securities, which I'm going to just take from the top and take out the book value of debt. And it's really the book value we've been working with, but I don't want to get any fancier than this. But conceptually, there's something there. So the value of our cash and marketable securities should be up here somewhere. That's this number right there. So we're saying this is the value of your property, plant, equipment, your labs. Then obviously the firm has some marketable securities and cash, which don't necessarily produce growth. They're just investing, I guess, holding on to it for pay dividends or something. And then take out the book value of debt. Technically speaking, you should take out the market value of debt, but I'm keeping this a little simple. That's actually one of the things that you could take out. And I'll just take that number out there. Okay, and so this is going to be the conceptually, not perfect, value of equity. Okay, and the value of equity is going to be, go ahead and put an underline here, is going to be the 79 plus the excess cash that does belong to the equity holders, supposedly, and plus that number minus the value of debt, and you get 73,799 more or less. Okay, and we're going to take out the number of shares. I think I've been saying all along. I'm going to use the same number of shares that I had for these right here, 1079. You can just do this equals 1079. Those are shares. And I'm going to divide those two numbers again. I'm going to go ahead and divide those two numbers. And those two numbers is going to give me my value per share. And the interesting part of this is going to be comparing the value per share with no growth with the value per share for equity. So your value per share is equal to $73 billion divided by 1,079 shares. Gives you a stock price of about $68.35. I know it's been, everybody here was probably in grammar school when I did this example, way back when. But that was actually almost hit the exact price of Lilly at that time. And just out of curiosity, let's see what Lilly is trading at now. Let's go to Yahoo Finance. Yahoo Finance. And let's just see what Lilly is trading at now. The stock ticker symbol is LLY. So LLY, ooh, 271.78. Wow. That thing's gone way up. Oh, that's Lam Research, excuse me. LLY, Eli Lilly and Company. 156.71. Okay, and actually what I'm going to do is I'm going to go and I'm going to do the max chart for Lilly, which probably goes back to the turn of the 18th century. But if you look at the pointer right here, it did go down. That was March 1, 13. Let's go back here. It's 08, 03, 03. This was 2002. I want to show you that around 2002, it was trading between, 2002, 2003, between $59 and $73. So the model that we built here, and we did it way back when we did it in a slightly fancier way, but just the basic model worked quite well. This would be a hold. That would be a hold because trading between 59 and 60, 73 gives you a 60. It looks like a hold to me. So the final, going back to 2002, that range, that date, the model worked pretty well in that case. So we came as a conclusion, we would come to the conclusion back then that it were a hold. And of course, and we did take the debt out. There's ways to actually calculate the market value of the debt, take that out. I don't think there's much difference here because there's a lot of current items. We did take some non-operating items. There was the growth rate at the time was 20%. I think the cost of capital was pretty good. These are always questionable, the constant growth rate. But the interesting point to see is if you assume that the firm, now keep in mind that we've used the same inputs. Our basic input was the free cash flow of the firm, which we used in the growth model, and also up here in our no growth model. So we're using a lot of the same numbers. And so with no growth, we get a price of $11.66 with growth. And compared to the market, by the way, we get a price that's $56 higher, which looks pretty darn good. The model worked well in this case. Anyway, so I will be emailing you. There's 4 videos. I've done them all today, Wednesday, April 22nd. I'll email you later tonight, and I will get toward finishing this course. And I'll tell you in the email that I graded a lot of your stuff already, and it's in your Dropbox. But anyway, I'll get back to you later tonight because I want to go take a walk after having been in front of this computer making videos all day. But I'm sort of pleased with this model. The stock market back in those days was a good place to put your money. Less volatility. The economics were more honest. Interest rates were 5%. You could get a real return on risk-free investments. Now it's basically a fraud with negative interest rates and everything else. But that's the way life goes, I guess. Anyway, so $68. I would have considered that back in those times about a hold. And you did see it went down after that. But anyway, so I'll get back to you in the email, and everybody stay healthy. Thank you very much. Okay.